Traditional active managers incorporate both data and judgment into their investment process. However, they tend to be overconfident about their judgment, and as a result, they tend to have under-diversified portfolios. Passive managers, in contrast, tend to have well-diversified portfolios because they follow broad market indexes, but they don't incorporate information into their investment process. Ideally, one would want a repeatable process that allows one to overweight stocks that have high returns and underweight stocks that have low returns, all within a well-diversified portfolio. Rules-based investment strategies like factor investing lie somewhere in the middle of the spectrum between active investment and passive investment. When optimally implemented, this strategy will lead to a well-diversified portfolio, a portfolio with modest turnover, and higher expected rates of return. Now, the problem with factor investing is this has become a relatively overcrowded field of late, and as a result, if you're not optimally implementing these strategies, you're going to actually have lower returns. Okay, our view is that what we need is agility in both the formation and implementation of this strategy. To a large extent, my research over the last 30 years has focused on identifying attributes that are related to rates of return. Okay, I like to think in terms of two types of attributes or characteristics. I'll call one firm characteristics and the other flow characteristics. Firm characteristics, for example, are things that we might learn from a firm's accounting statements. A good example that I like is share repurchases. Okay, when a manager wants to repurchase shares of his own stock, it's an indication that he thinks that his shares are underpriced. There's a lot of empirical evidence that indicates that when managers repurchase shares, stock returns in the future are positive. Flow characteristics are characteristics that we learn from things like the recent past stock returns, trading volume, and one attribute that I like a lot is short interest. Short interest tells us when large investors, hedge funds, other institutions are shorting the firm's stock. Okay, our evidence suggests that when these investors short a stock, that's an indication that the stock is going to do poorly. What we're essentially doing is learning from the actions of others to help us better form our portfolios. Empirical evidence shows that both firm and flow characteristics predict returns better for small cap stocks than for large cap stocks. This is natural given that we expect small cap stocks to be less efficiently priced because they tend to be followed less by analysts and traded less by large institutions. Implementing small cap strategies in real life portfolios can be challenging because the cost of trading small cap stocks tend to be higher. There are two costs associated with trading. The first costs are the direct costs. These are things like brokerage commissions. The second is what I'll call implicit costs, which are basically market impact costs. The evidence suggests that market impact costs are higher for small cap stocks than large cap stocks. The takeaway here is that if you want to manage a small cap portfolio, it's better to keep that portfolio relatively small. Acclivity Investment Research was created to deliver best-in-class investment solutions for our business partners. We leverage decades of academic research into the creation of our investment products. Agility is our main source of comparative advantage. By agility, I mean the ability to very quickly identify, validate, and incorporate new information into our investment models. Agility requires state-of-the-art investment infrastructure which is something we pay substantial attention to. And to maintain agility, it's important to understand capacity constraints, which means it's important for us to remain relatively small.